Alex believes he's rewarding himself for years of hard work. Ryan believes he's building a future most people only dream about. Both feel confident. Both feel rational. And both think the other guy is making a mistake. But 20 years from now, one of them will have the freedom to stop working whenever he wants. The other will still be trading his time for money. Not because he earned less. Not because he worked harder. And not because he got unlucky. The difference comes from a purchase millions of people make every year without thinking twice. A purchase that feels like success, looks like success, and is often celebrated as success. Yet many self-made millionaires quietly avoid it. Not because they can't afford it, because they understand a hidden cost most people never calculate. A cost that doesn't appear on the monthly payment. A cost that grows larger every single year. And by the end of this story, you'll see why two people with the same income, the same savings, and the same opportunities can end up living completely different financial lives. But before we get into the numbers, hit the like button and subscribe to Capital Logic. Because understanding how money works is often more valuable than earning more of it. Alex and Ryan are both 30 years old. Both earn $80,000 a year. Both have $50,000 saved. Both receive similar raises. Both want financial freedom. And both believe they're making responsible financial decisions. The only difference is what happens after payday. Alex decides it's time to enjoy the rewards of his success. He buys a brand new luxury SUV for $60,000. The dealership experience is perfect. The leather seats smell new. The technology is impressive. People stare when he drives by. Friends congratulate him. Coworkers notice. For the first time, Alex feels like he's made it. Ryan takes a different path. Instead of buying the luxury vehicle, he purchases a reliable used car for $20,000. Nothing flashy. Nothing exciting. Nobody compliments it. Nobody asks questions. Nobody cares. The remaining money stays invested. And every month, Ryan invests what Alex spends on his vehicle payment. At first glance, Alex looks like the winner. In fact, almost everyone around him thinks he's the winner. This is what makes the story so interesting. Because wealth and the appearance of wealth are often completely different things. Year 1 arrives. Alex loves his decision. Every drive feels exciting. Every parking lot feels different. Every compliment reinforces the feeling that he made the right choice. The monthly payment is $850. Insurance is $200 higher every month than Ryan's. Fuel costs more. Registration costs more. But none of it feels painful. The emotional reward is immediate. Ryan experiences the opposite. Nobody notices his decision. Nobody congratulates him. Nobody admires his discipline. His reward is invisible. An investment account quietly growing in the background. If you only looked at their lives after 1 year, you would almost certainly choose Alex's path. And that's exactly why so many people do. Because immediate rewards are easy to see. Future rewards are not. By the end of year 1, Ryan has invested roughly $12,000 more than Alex. Assuming an average annual return of 7%, that money begins compounding. Not dramatically. Not yet. But the process has started. And compounding always starts slowly. Year 3 arrives. The excitement starts fading. Alex still enjoys the vehicle. But something unexpected happens. The thrill becomes normal. The luxury becomes familiar. The thing that once felt extraordinary now feels ordinary. Psychologists call this hedonic adaptation. Humans adapt to improvements surprisingly fast. The vehicle hasn't changed. Alex has. Meanwhile, new expenses begin appearing. Maintenance. Tires. Unexpected repairs. Higher insurance renewals. The costs continue long after the excitement fades. Ryan's life looks less exciting. But his investments continue growing. Month after month. Quietly. Predictably. Without applause. This is where things get interesting. Because Alex still looks wealthier. His lifestyle appears more successful. His social status appears higher. But the numbers are starting to tell a different story. By year 3, the SUV has lost a significant portion of its value. Not because something went wrong. Because depreciation is doing exactly what depreciation always does. The moment a new vehicle leaves the dealership, its value begins falling. Ryan's investments are doing the opposite. One asset is losing value. The other is gaining value. And yet most people still think Alex is winning. This is the power of visible wealth. It can hide invisible losses. Year 5 arrives. And now the gap becomes impossible to ignore. Ryan has consistently invested the difference. His portfolio continues benefiting from compound growth. Alex has now spent tens of thousands of dollars on payments, insurance, fuel, taxes, maintenance, and depreciation. But what nobody talks about is opportunity cost. Opportunity cost is where the math changes. Because the true cost of buying something isn't just the money spent. It's what that money could have become. Every dollar invested has the potential to multiply. Every dollar spent loses that opportunity forever. Imagine two seeds. One is planted. The other is eaten. Neither decision is wrong. But only one seed becomes a tree. Money works the same way. By year 5, Ryan's net worth has quietly moved ahead. Not dramatically, but enough to matter. And the story isn't over. Because the next 5 years change everything. Year 10 arrives. Alex is now 40 years old. Ryan is 40 years old. Their incomes have increased. Their lifestyles have changed. But one thing remains different. The effect of that original decision. Ryan's investment account has crossed a level that feels meaningful. For the first time, he begins seeing tangible evidence of financial progress. The portfolio itself now earns money. Not through effort. Not through overtime. Not through promotions. Through ownership. This is the moment many investors wait years to experience. The moment when compounding starts doing noticeable work. Alex experiences something different. His vehicle has long since lost most of its original value. In fact, he has already started thinking about replacing it. Because newer models look better. Newer features seem attractive. And this is another hidden cost. Lifestyle upgrades rarely happen once. They tend to repeat. People become accustomed to a certain standard. Then they upgrade again. And again. And again. The cycle continues. Here's the twist. Alex isn't irresponsible. He's not reckless. He's doing what millions of financially responsible people do every day. Which is exactly why this lesson matters. Most wealth destruction doesn't come from one disastrous decision. It comes from dozens of normal decisions repeated consistently over time. Year 10 reveals another hidden cost. Inflation. The luxury SUV looked expensive at purchase. But inflation has quietly increased the cost of everything else too. Fuel, repairs, insurance, replacement parts. Ownership becomes more expensive every year. Ryan faces inflation as well. But his investments have historically provided growth that helps offset it. This doesn't eliminate inflation, but it changes the relationship. Assets often fight inflation. Cash and liabilities often struggle against it. By now, Ryan's net worth advantage is becoming substantial. And the next part changes everything. Year 20 arrives. Alex and Ryan are 50 years old. Both worked hard. Both earned good incomes. Both avoided major mistakes. Yet their financial positions look dramatically different. Ryan's disciplined investing has benefited from 20 years of compound growth. The money he invested didn't simply grow. It multiplied. The returns generated returns, which generated more returns. This is the part most people underestimate. Compounding doesn't move in a straight line. It accelerates. The final years often produce more growth than the early years combined. Alex isn't broke. Far from it. He still has savings. He still owns assets. He still built a decent life. But his net worth is significantly lower than Ryan's. Not because of a single purchase. Because of everything that purchase triggered. The payments, the depreciation, the insurance, the maintenance, the taxes, the upgrades, and most importantly, the opportunity cost, the money that never got the chance to compound. Now, before we declare Ryan the winner, we need to be fair. Because real life is more complicated than a spreadsheet. There are situations where Alex's decision can absolutely make sense. If the purchase genuinely improves quality of life. If it motivates someone to work harder. If they already have a strong investment plan. If the expense represents a small portion of their wealth. Then the financial impact may be relatively minor. Money exists to improve life, not simply to accumulate forever. Likewise, Ryan's strategy has risks too. Investments don't guarantee returns. Markets fluctuate. Economic conditions change. Unexpected events happen. A person who delays every purchase and sacrifices every enjoyment can also miss valuable experiences. Financial success isn't about maximizing every dollar. It's about balancing present enjoyment with future freedom. This is why intelligent wealth building is rarely about extremes. The goal isn't to never spend money. The goal is understanding the full cost before spending it. And that's the lesson many self-made millionaires understand. They don't ask, can I afford this? They ask, what is this money worth if I leave it invested? That's a very different question. And it often leads to very different decisions. Because the real mistake isn't choosing the luxury SUV. And the real mistake isn't choosing the investment account. The real mistake is making the decision without understanding the full math. Understanding the depreciation. understanding the taxes, understanding inflation, understanding maintenance, understanding risk, and most importantly, understanding opportunity cost. Because once you understand the full math, every financial decision starts looking different. If you enjoyed this video, make sure to subscribe to Capital Logic and turn on notifications for more stories that reveal how wealth is really built. And if you're wondering what happens when someone combines both strategies, that's a completely different conversation. And the numbers might surprise you.